Good afternoon, everyone. This is Mark Robertson, 506 Investor Group. Today we have another in our series of webinars with Apexone. They're going to present on their Multifamily Fund III. We have Jim Hearn and Ernest Johnson with us. Welcome, gentlemen.
Thank you, Mark. Thank you.
Thank
506 Group.
And
Glad to have you.
Just go over the fund for the first half of the webinar, and then we'll jump into some Q&A.
That's fine. Mark, I'm not sure how you guys are set up. Do they send you questions if I go through the deck? Do they send you questions and you want to stop and ask a question as I'm going through the presentation? Or do you want to wait to the end? I know you have some questions already regarding the structure of Fund 3. As we go through the presentation, would you prefer to just ask while we're right there?
Yeah, usually we wait for questions till the end. I mean, I may occasionally butt in if I see something glaring that I want to clarify, but for the most part, I'll go ahead and go through. And you guys are caller 1 and 2. There's a couple here that don't need to be muted because it's more loud. I'm on mute 3. I hope that's not you guys.
No, Jim and I are together. So.
Oh, okay, so I'll mute 2 too. All right, there you go. You're good to go.
Can you hear us still?
I can.
Okay. Great. Well, first I'll thank everybody for your interest in Apexone Multifamily Fund III. As many of you know who've invested with us in Fund II, this is a continuation of the strategy of the fund, of Fund II, I should say. We are refining the, where we look in terms of student housing properties. We're focusing primarily on non-primary schools. We found that the larger schools are just too competitive at this point. Pricing is just at the point that we don't think there's a comparative yield benefit paying these prices for these properties, but we like the secondary schools, and we'll go into that for a minute. But basically, it's a continuation of the strategy. The important disclosures, which I guess this is recorded, we can send this out so y'all can review those at your leisure. Just a little bit of information about Apex for you, those of you that have not kept up with us. We have 4 locations: Houston, Chicago, West Palm Beach, and Phoenix. The main office is in Houston. The satellite locations are just where we have offices because of employees that are there. And we have an office in West Palm Beach that I spent some time in as well. Together, Jim, Tim, and our other team have run about $11 billion of assets and transactions in portfolio management. Combined, we have about 150 years of experience. We're all older than we look or sound. We acquired 33, that's actually 34 properties now in the 2 funds. The aggregate purchase price of those properties is closer to $850 million with the last closing we did in Fund 2. We have $212 million of assets under management, and that's comprised of the $17 million we had in Fund 1, the $55 million in Fund 2, and then the joint venture money that we manage on behalf of those partners as well. So we've invested basically $212 million of equity in properties over the last few years. The weighted average return of our full cycle properties in Fund 1 is 33.9%. We did have an outlier that came in at about 116. So even if you take that out, we're still in the 26-27% IRR for the fund. The current yield on invested capital in Fund 2 as of June 30th is 9.2%. That's the yield on the money that we've actively invested in property. It does not include money that was sitting on the sideline. So, we think both funds are performing well and certainly above our expectations. I should say that I think they're performing at our expectations, but above the stated terms of the PPM. The chart on page 4 is just showing that, it's a visual illustration of the number of properties, the amount of square footage, the number of units, the number of beds that we've bought, not square footage, and the volume that we've purchased since Jim started the company in 2012. So we see that trend continues. It seems to me every year, every time we start a fund, there's investors that say, gee, can you find properties to make these numbers? I think this is a visual display of, yes, we can find the properties. We look at a lot of deals to find the ones we want to do. But we think we can continue with this velocity and volume. These are the sort of the metrics between Fund 1 and Fund 2. And again, it's just a breakdown of the properties, the vintage of the funds, the number of properties, et cetera. Sort of an interesting number that people have looked at and that was asked is the amount of money we spend on renovations. I think a lot of people, when they think renovations, they're thinking we're spending $15,000 to $20,000 a unit. And that's not necessarily true. We're spending between $4,000 and $5,000 a unit between the two funds. Some of those have been as low as nothing. Some have been as high as $8,000 a unit. We continue to find the most bang for our buck. If y'all, looking back how we evaluate and how we spend money on our properties, there's three areas that we focus on, and in this order, we have three phases to our renovation plans as we go in and acquire properties. The first phase is to change over management. We find repeatedly that these properties are just very poorly managed, and there's a lot of theories out there on why that holds true, but it's just happening more than you would think, especially in a consumer-driven society that we've all grown up in, where the customer's always right. What we're finding in the workforce housing sector, and this is from interviews from property managers and from residents, is that most owners of this property type realize there's a shortage of properties in this sector. The residents don't have a lot of options in terms of where they can go, and they tend to raise rents without providing any value back to the residents. They're not spending money on the common areas. They're not renovating the units. They're not really doing that much. And, so as a result, the rents have gone up and the residents have gotten very little. We come in there and take the other approach that we are going to really take care of the residents. And we start by putting good first-class management in place, people that are very customer responsive, resident responsive, that realize, first and foremost, this is not an owned apartment complex. This is somebody's home you're managing. And so once we have that attitude and that mindset, we take care of the residents. The second phase is we start the common area renovations. Again, our investment philosophy is to give the people living in these B+ and A- properties an A+ living experience, at least in the common areas. We want them to have those really great amenities. Y'all may not realize, but the gap between Class B and Class A properties is about $525 a month. That's up from the traditional separation of about $200 to $250. Which means that somebody moving up to a Class A+ property from one of our properties is going to be spending about $6,000 a year after tax to live in a nicer place. We want to give them that nicer place at a price they can still afford. Remember, our residents are firemen, policemen, nurses, teachers. It's America's workforce. And Jim and I have a common joke that if we pull up, and this happened in Orange Point, or Point Orange, Florida, at Ocean Oaks. The first time I went there were 7 or 8 police cars parked in the parking lot. And our joke is that as long as those lights aren't flashing, if we see 7 or 8 police cars in the parking lot, we know immediately that's our kind of apartment complex, because these are the kind of residents that we like. And so, we give them these great common areas. And then the third phase is to start the renovation process. And so we found a lot of times we have gotten so much lift in rent from changing the management and bringing the common areas up to a level that they're very proud to bring their friends over to. We convert the pools to resort-type pools with cabanas, padded seats, put in dog parks, outdoor kitchens, do all these things, really dress up the landscaping, just add what needs to be taken care of, and then we start renovating the units. And so what we're finding is we're not having to spend as much because we're getting a lot of bang for our buck. And some of the properties in Fund 1 and 2, we've actually quit the unit renovation program because we can't get that much more rent by improving the units because we've gotten so much lift from a change in management, the upgrade of the common areas, and just taking care of the tenants. And so, we're very careful about managing that money. So that's why you'll see that fluctuation. But it's a common question, that people have asked. Our leverage ratio is 65 to 70%. You can see that in Funds 1 and 2. And then you can see the return. So a little bit about Funds 1 and 2. This is our management team. We're pretty small in terms of what we do. We outsource a lot of our work, including the third-party financial services, audit, et cetera. So all of those are handled third-party. It keeps us from being the Bernie Madoffs with 3 guys in the back of a room just sending out checks. We have a diverse management team, as you'll see, and we're very proud of that. I've just, this is our Fund 3 investment strategy. I basically went through it when I told you about what we do. We just think that job growth and wage stagnation have combined to create a workforce population in need of housing where housing doesn't exist. We know statistically this group is having a very difficult time buying homes. They can't accumulate enough of a savings to buy a starter home. The price of starter homes have gone up dramatically. It's about $270-something thousand for a starter home if you can find one. They also have trouble qualifying for a loan because they have to have near perfect credit. There's talk about these, where you can put 5% down and buy a home. Those are really rare deals. And again, you've got to have that perfect credit to make that work. So there's just a shortage because of rising construction costs, rising interest rates, and a stagnation of wages that this group that's making $60,000 to $120,000 a year really just can't afford to buy a home. And they're very reluctant to pay more money in rent to live in those Class A or premium housing locations. So we like to acquire underperforming assets, and we talked about that a little bit before. Most of these underperforming assets fall into three categories. They're very poorly managed, they've spent no money on common area upgrades, and they certainly haven't touched the units in terms of renovations. So we look for those underperforming assets that we can acquire and turn around with our three-phase strategy. We then hire the best-in-class on-site property managements. We have basically three management companies that we use. The Collier companies down in Florida primarily, Balfour Beatty communities we use around the country, and Hawthorne residential properties out of not Columbia, but
Hawthorne is out of
Charleston, South Carolina. I'm sorry, I had my South Carolina, and we do deals with them on a 50-50 basis. So all of our management partners, it's not unusual for them to have some skin in the game to invest anywhere from 10 to 50% alongside us, and so they have money at play as well. And then our return targets are, based on a 3 to 5 year hold. We're looking at yields of 7 to 9%, and a return to the investor, a net return to the investor of 13 to 15%. And again, we touch base on this just to hit some numbers that y'all may not be seeing. The workforce is growing. These are projections from the Bureau of Labor Statistics that shows basically about almost 400,000 workforce jobs a year being created. But there's only about 48,000, best case, workforce homes being built. The rule of thumb is for every 5 new jobs, you need 1 new home. So you can see that this is running at about 1 new apartment for every 8 jobs. So again, that ongoing demand and a supply imbalance. And amazingly enough, a lot of these 48,800 homes that are being delivered into the workforce housing sector, at one time they were affordable housing, and affordable housing is usually built with some kind of tax credits. And once those tax credits burn off, the owner can take those to market rate properties. And so that is one of the primary source of new deliverables into the workforce sector. But there's only about 1.5 million units of low-income credit housing out there. So it's not an inordinate amount, but it is almost impossible to build, given today's construction prices and land prices, to build something that you can rent for $800 to $1,500 a month. It's very, very difficult to do. So that's the source of the imbalance. Again, this is just a visual of how much does somebody make. Workforce is defined as the individuals making 60 to 120% of the area median income. That is the federal government's definition, and they use it for loans and a lot of other purposes. So this gives you an idea of what that number has looked like and how it has grown, significantly over the last few years, but it's still not that much, in the whole measure of things. So that gives you an idea. We tend to focus on properties that are affordable to somebody making 80 to 100% of area median income. And the reason for that is we believe once you get down to 60% or $36,000 a year, you're probably going to find a way to get into some kind of government assistance or government aided housing. So that's really not one of our residents. Once you get past the 72 to 75,000 a year, then you probably are getting into something a little bit newer, maybe not the A plus at 500, but maybe you are willing to spend another, $3,000 to $4,000 a year on rent. So, but those people that 80 to 100% is our primary focus, and that was the purpose of this visual. And then our student housing, again, we're looking at non-primary colleges, universities. A couple of reasons for that. The non-primary schools typically cost about 25 to 40% per year less to go to, which reduces the financial burdens on families and the students. It prevents them from having to take out larger student loans. And because the students going there do not have the financial means of some of those attending the larger state and private schools, their housing costs, they expect it to be lower as well. So once again, you can't come in and build the newer student housing and deliver it to the students that are looking to rent that housing. To give you an example, one of the newer construction projects we've seen was at Park West at Texas A&M University. They spent about $110,000 a bed to build that project. They expected to rent it for about $1,050 to $1,100 a month. I can tell you at Troy University in Troy, Alabama, there's not very many kids there that are going to pay $1,000 to $1,100 per month per bed. So they can come to our project and be in the $450 to $500 range. So we think these secondary schools, because of the lower cost of attendance, it's kind of workforce kids that are going to these schools. They're getting a good education. They're getting it at a lower rate. An interesting stat I was talking to the Dean of Students at Middle Tennessee State University, where we have a project in Fund II, and the average income of their family student was about $80,000 a year across the board, Middle Tennessee State University. You go to the University of Tennessee, that more than doubles to about $170,000 a year is the average income of the families of the students going to the University of Tennessee. Middle Tennessee State University is 25% cheaper in tuition. The housing is cheaper. So again, and they have grants and programs to help students. So that's the disparity. So we think more and more students realize they need to have this college education. And maybe they go to the smaller schools for a few years and then move up to the larger schools. But we're still seeing strong enrollment demands at these secondary schools. But what we're not seeing is the new construction and the addition of supply that you're seeing at the big schools that's destroying some of those markets. So that's why we're looking at this. And we think that, again, applying the same concept by going in and doing the renovations to the common areas, giving these students a good management experience, we're enhancing their learning environment, which helps them, we think, graduate and get through school. We're making it affordable for these families that are looking for a good place for their kids to go to school and don't want to take down large student loans. So that's our primary reasons for focusing on the secondary schools and universities. So that gets us through. The rest of these are case studies, but Mark, if you had anybody send in any questions or anything they'd like to cover, I'll be glad to discuss our investment philosophy.
No, I guess the one question would be, compared to, say, a year ago, what are cap rates for this sector, and also what's our borrowing costs now? What's the change in interest rate in a year for what you found?
Mark, certainly interest rates have risen. I think everybody's watches the financial news and has watched what LIBOR and the 10-year Treasury have done. The rates have moved from the low fours to the middle high fours. I mean, there's a lot of different ways to borrow. The truth be told is our typical way of borrowing is to borrow 70 to 75%. We generally borrow from Freddie Mac. We generally borrow on a 7 to 10 year basis, and we generally, most often, particularly on market rate, on workforce housing, the market rate stuff, we will use a floating rate instrument, and we will buy a hard cap that protects us from, escalating interest rates getting too far out of hand. We've done that successfully in both Fund I and Fund II. And we've done that in both Fund I and II with success. And another reason that we like to use the floating rate instrument is that it gives us a lot more flexibility on a sale, because you're avoiding the yield maintenance and defeasance costs that sometimes get terribly out of hand when you want to sell in 2 or 3 years. The cap is not terribly expensive, and you can buy it for a few years. So on a 4 3/4 rate, which is pretty similar to what we'll be closing on the Germantown deal, that'll be the first acquisition for Fund III. You can buy a cap at 5 3/4 or 6 for $85,000 or some number pretty similar to that, and we think that's money very, very well spent.
For how many years is that? The cap.
The cap?
Yep. That's your cap.
Generally 3. It escalates quite a bit if you buy a 4th year, but if you're you're fixed for a certain position in the loan, and each one is slightly different, and then you can buy a cap for 3, and then we can rebuy the cap.
Yeah,
we can reprice the cap and buy it again later, and we've done that a couple of times as well. We fully expect. It's a great question, and it comes up in every call we have. So I'm glad you asked it about interest rates, because there's a philosophy of Apex One from top to bottom, and there's more to it than just going, well, we're going to put a cap on it and we're all going to be good to go. We typically buy these deals on, say, between 5 3/4 and 6 1/4% cap rates. I know you've probably heard of a million deals that have closed with crazy low cap rates, and we just don't play in that particular game. Those are the lowest cap rates are clearly on Main Street, more clearly First and Second Avenue type buyers. But you will find us buying cap rates, never ever lower than somewhere in the upper middle 5s. We want a positive arbitrage against our interest rate. And then when we use 65 to 75%, debt and LTV and loan to value and loan to cost basis in analyzing our deals, then you've got a positive arbitrage. And then when you go to our projections, if we bought a deal on a 5 3/4% cap rate, you can be dead sure that we're expecting to sell the property on a 6 to a 6.5 cap on the way out. Now it's guesswork, but we've built in a spread on what we anticipate our loan to be going into the deal. We've capped our loan. We've got a higher exit cap rate. And again, each one of those are done by, it's an art. It's not really a science. They're done by feel. If you buy a deal, if the market's 5 1/4 and we sneak off with a deal at 5.6, we're probably expecting to sell it on 6.2. If we buy a deal on a 6, we're probably expecting to sell it on a 6.5 or a 6 3/4 down the road. As a general rule, cap rates have not moved up as fast as interest rates have creeped up. That's beginning to change. In certain markets, we don't own anything in Las Vegas, but I just spent an hour yesterday talking with a Las Vegas broker who I've known for 25 years, who tells me that particular market is already starting to see resistance to the real low cap rates that have been floating around in the Salt Lake and Phoenix, Tucson, and Las Vegas areas. So that will mean that we're going to see a little bit of pricing stress in some of those markets, which really, we look at about 400 to 500 deals a year, and we only buy 7 or 8. So we're pretty picky. By the time we've worked it through our system here, I think we've got a pretty good answer for a market that's escalating in a pretty predictable fashion. Does that answer your question?
It does. So the cap rates last November are similar to what they are now, or gone up maybe 0.1, 0.2%.
And again, it's different in Las Vegas and Phoenix than it is in Orlando, than it is in Cincinnati. But as a general rule, yeah, cap rates are beginning to creep up a little bit. You got to remember, in the bigger scheme of things, there's like $6 trillion of money sitting on the sidelines worldwide that's aimed at real estate of one fashion or another. Now, clearly not all of it is going to come to the U.S., although a great portion of it does. There's still a lot of liquidity out there looking for a home. And that amount of liquidity on the sidelines is always going to keep some downward pressure on overall cap rates. The farther you get away from institutional type assets, you may see a little bit more movement in cap rates. But with that kind of liquidity hanging around on the sidelines, even with interest rates going up, you've still got an incredible amount of money that is seeking yield, and you still don't get squat with your money sitting in the bank. It's better than it used to be. It's gone from absolutely terrible to now it's just terrible. I think we've been getting so used to making less than a half a point on your money sitting in the bank that I think we're all numb to how pathetic that is.
Yeah, you can get 2% now, which is not great, but relatively speaking, it's pretty good. Let's see. The first question was, please explain the 50-50 catch-up of carried interest provision.
Yeah, the way the deal is structured is we're 80-20 partners in the deal, and you've got to have a methodology to get you to the 80-20. So, basically the way the waterfall is set up is the limited partners receive an 8% preferred return on their invested capital. They then receive their return of all their capital commitments, and at that point we become 80-20 partners. And so to get us, to get the general partner whole on the 20%, we get I've seen some of these deals where it switches, where suddenly the general partner is getting 80% and the limited partner is getting 20% until they get balanced at the 80-20. So we're doing it at 50-50. So after the investors get all their money back and their 8% return, we start splitting the profits 50-50 until we've received 20% of the return that the investors have received, not return of capital, just return on capital. So it's a methodology into where we can catch up and be 80-20 partners on the deal.
Yeah, it's actually better than some. Some are 100%. You get the next 2 or 3% until you're caught up to us, and then we split.
Right, and there are some deals that are 80-20 from day one.
Yep.
It's just the old head. It's a 20 and 2 model. You get a 2% asset management fee and 20% of all cash flow. I'd love to give that, but I don't think anybody will give that to anyone these days. So that's how we catch up with it, Mark. That's a good question. Thanks.
And then page 18 of the PPM, please explain JV's carried interest position.
Yeah, the JV carried interest, and again, the term joint venture and carried interest is used a couple of times throughout the document, and it's not always the same thing. For instance, we have a carried interest in the fund. What we're talking about in a joint venture carried interest is carried interest in a deal where the fund is promoted, not the general partner. So, as an example, we've done some deals with American National Insurance Company, and we put in 20% of the money in one of the deals we did with them. Once we hit a 7% return from the property, a 7% return to both investment groups, the fund then starts receiving 40% of the profits. So our carried interest in the deal is that 40% of all distributions over a 7%. And so that's what the carried interest is. And that's just an example. And they're all over the board. I wish I could tell you here's this one set way we do it. But, that carried interest may also be reflective of how you deal with additional risks in the deal, what the yield is coming out of the fund, the number of times we've done a deal with somebody, if they're bringing something to the deal. Like, for instance, with Balfour Beatty, there is no carried interest because we basically do 49-51 deals with them where they're putting in 49% of the equity, we're putting in 51%. They can't put in more than that because of they're a UK-based company that have dual taxation. But the things they do for us in return is they manage the properties at a little bit lower property management fee, which benefits the investors. They help us tremendously on the due diligence, and they don't charge us for that. That's just their cost to be partners with us. They have one of the largest construction companies in the U.S., the largest in the U.K. And so as we're doing some of our due diligence and renovation planning, we'll run those numbers by their construction guys to see if it's realistic or what they're seeing. We never hire them to do the construction because we thought that would be a conflict. But that's somebody that's bringing something to the equation, and we don't have a promoted interest with them. And so that's what the carried interest is. It's just a way to give a disproportionate share of the profits to the investors. And the other reason we like that is it allows us to diversify our asset base and risk across a larger geographic dispersion. The other thing we like about it is it also, in addition to lowering our risk, it increases the return. An example of that is the deal I just mentioned that we're doing with American National Insurance Company. I think we wrote that deal out to where it was going to be about a 16% property level return, maybe a little higher, maybe closer to 17. By bringing them in and with that promote, doing nothing different except bringing in their money, we increased the return on that property to about 28 to 29%. So it gave us, again, a nice high return to investors and a significant amount of distribution upon the sale of the property. So that's the joint venture carried interest.
So all that carried interest goes to the fund level, not to management levels.
All goes to the fund. We never take a dime of any carried interest on anything.
All right. Page 40.
All the joint ventures.
Go ahead.
Pardon? What was that, Mark?
No, I was going to say all the joint ventures are quite accretive to the investor side of the deal, because all of the waterfall benefits accrue directly to the fund, which accrue directly to the investor's benefit. The only thing that we promote as a sponsor is the fund as a whole.
Yep. So
the more successful joint ventures we do, the faster you guys meet your return criteria, and the faster we can get to the back end of the equation.
And I just saw that the target return is 13 to 15%. Fund one, what's your best guess of what it's going to end up being at the investor
level? I think it's going to be conservatively 26 to 28. Fund one?
Yep.
Yeah, 26 to 28.
And Fund two is probably too early since you're just closing on some of those.
Yeah, but it's interesting. Fund two, the yields on some of those properties are doing better than Fund one, which is kind of strange given the vintage. Fund two, I think Fund two will still be north of 20. And I wouldn't put that in writing because as soon as you're 20, you don't believe it. But I'm looking at some deals that are throwing off 12 and 14%, and I know what they're doing in terms of valuations. And then we have the joint venture partners in those deals. So, I think Fund two will do 20.
Just a side question. The Texas A&M market, has it gotten any better? I know there was one.
It's getting better. I wouldn't buy anything there. But, the good news is we only have we have about 40 something, low 40s, $43,000 a door in that deal, I believe. And even in that market, the appraisal, and our appraisals are done by our audit firm, Weaver and Tidwell. They have a valuation division. And so they valued that property at $44 million. We made money on the buy on that deal. A property recently traded over there to a private investment group. And the reason I know about it is a friend of mine invested in it. And it traded at about $63,000 a door. And it was the same thing, 87% leased. They haven't done all the property renovations. So we think, our property there has some value in it. Even if we get 55 to 60 a door, it's going to exceed our return expectations. The cash flow just isn't there right now because of the market, but there's only 2 deals coming online there, and they've been planned and under construction. Enrollment is still increasing. We think the school is going to have to increase the rent on their Park West asset, and that's going to drive kids back into our assets. So it's going to be another year, but we think, we're fingers crossed we have a good leasing year this year. We'll put that property on the market next year with a couple of the other student asset deals and probably sell it as a portfolio.
All right. Page 46 of the PPM is organizational expenses, $500K or 0.5% of aggregate commitments. The confusion on that.
It's the greater of, but if you read that paragraph, you see it's really capped at $500,000. So that's the organizational expenses.
So
we can go over that.
$50 million, is that?
Okay. 500,000 is the cap, yes.
No, but the fund is 150 million.
Yes.
So it could be 750 but it's capped.
Well, anything over 500, we have to reimburse the way it says is the fund can pay us, and we can take that payment in terms of reduced asset management. But anything over 500 has to come out of the sponsor, and how we elect to bring it out, either just pay it ourselves out of our fund or have the fund pay it, and then we reduce our asset management fees or other costs going forward. But $500,000 is the cap we could draw out of the fund, but 500 is the max we can charge to the fund. And one reason we did that is for tax purposes. We can run those expenses through against the fund and lower the investors' distribution by allowing them to take that expense instead of us having to book it as income.
All right, same page, PPM, the placement fee of 3% of aggregate capital commit.
Yeah, that is only if a investment advisor can take a fee. We have yet to pay any kind of a fee. And we didn't do it in Fund 2. We did in Fund 1 because we had some advisors. But most RIAs cannot take a fee, and so we don't pay. We just have it in there in the event that we came across a broker-dealer or somebody that had a 3% fee. But then if you read that paragraph all the way through, anybody that comes in with a broker-dealer, their capital contribution is reduced by the amount of the fee that we have to pay, and the other investors don't get diluted by us having to pay that marketing cost to the broker-dealer. So we're just saying that we can pay it, but if you come in, your $500,000 is now $485,000, and that's the basis for all your calculations and return of capital.
Wow, that's good news for us. All right, page 39 of PPM, where co-investments have a different waterfall structure. I guess for our 80/20.
That's an interesting question, and the answer is they could, but never to the detriment of the fund. What co-investment is talking about is we actually have a co-investment between Fund 1 and Fund 2, and there is a different waterfall between the two funds. But again, it doesn't matter because Fund 1 has 10% of that deal, Fund 2 has 10% of that deal, so all the profit and cash flows go 10% those deals, and then once it goes into the fund, how it's split between the sponsor and the limited partners, is spelled out in the fund. So it will never, co-sponsorship will never impact the investor's returns. Because again, remember, the waterfalls do not promote to the general partner, they promote always to the limited partners.
Yep. But you wouldn't do a 90-10 or something crazy like that. It'd be 80-20 or better or worse for the co-investment.
No,
it's really not applicable.
Yeah, we don't want to do any co-investment with this fund. The co-investors we could do with this fund, I can't even think of a reason we would. What that would allow, again, because I think this comes up to the question of parallel funds, and these kind of run, together. So let me give you an example of something that answers both the parallel funds and the co-investment funds. We have a group out of Canada, which is just beating Jim and I to death to invest money in the fund. Well, the challenge with that is they don't have a U.S. employee ID number. They don't have a Social Security number. And so any money that came in from them, we would have to do withholding on them and pay them a net distribution, withhold about, I think, 40 to 45%. The challenge is that then has some liability to the fund that we don't want to take. If that investor didn't pay us taxes, we have to pay it out of the money that we've held in reserve, and that's fine. You can do that. The way we would probably do that would be to set up a separate fund, maybe what's sometimes called a blocker fund, that would allow them to invest. Everything would be the same terms and conditions. Nothing would be different. The only difference is their money is coming into Apexone Multifamily Fund III Canada, and their money is separated from the other investors. So when we have to do this withholding, there's not any liability towards the general partnership or the limited partners, for this holding. So there they would co-invest with us. If that fund represented, say, $20 million of the 150, they'd co-invest, that percentage to the 130 we raise in our fund. And so they would be both parallel funds because we would invest in the same properties, but they would also be co-investments because they would be coming in together. And so that would be an example of a co-investment and a parallel fund operating simultaneously. But it just gives us flexibility.
And by the way, Mark, the whole concept of a blocker fund is a pretty expensive endeavor that we've shied away from.
Yeah.
Until you have a significant amount of foreign capital that wants to make an investment in your fund, it's pretty cost prohibitive to spend a few $100,000 setting one up and then finding out that somebody only wants to invest $500,000.
Yep. Now we've run across that in private equity stuff. It's usually a hassle.
Yeah, we would only do a parallel fund if it was at least equal to the standings of our limited partner investors. At best, we'd want it to be accretive to them. But it gives us the opportunity to maybe work through tax laws or different issues to bring that money in.
All right. Next question. What is the max amount of capital that can be called at any time as percentage of the total commitment?
To be honest, there is no maximum.
What's a realistic number?
There just isn't. Yeah.
Here, let me there's no maximum per se, but the fund limits the amount of capital that we can put in a single deal and in a particular area. Hypothetically, unless Ernest wants to stop me, I think the only way that we could ever call some giant percentage in one call would be as if we were buying some huge diversified portfolio and we're going to do it all in one fell swoop. And the chances of us finding a deal like that are probably about the same as me winning that $1 billion lottery.
Let me tell you how we'd manage around that. Let's again, because I think it's, when I look at investments, I always look at, okay, what's the worst thing that could happen here, and how are you managing around that? Because these situations are inevitable, and it's how you manage. It's like conflict. Conflict in the world is inevitable. It's how you manage your way through it. So let's say we did find some off-market deal that was just too good to pass up. We call a couple of investors. We call Mark to represent his group, and I'll say, hey, look, guys, here's this deal. We talked to our investment committee. And Mark, one thing we should say to you guys as part of our, we have a committee that's going to be, made up of investors that are going to help provide an oversight in this committee of the fund. And I think we can have, 6 or 7 of those. Just given the size and the activity of your group, I would, probably want to have you or one member of the 506 be on that group, so you all have good representation. So that's kind of as a side note. But we would go to our advisory committee and say, look, here's this deal, and literally to take this thing down, we're going to have to pull down all $150 million of the commitment. We're going to have to send it in. So there's a couple of ways we can go about that. One, we could just call the 150, and we have a conference call with all the investors and say, hey, look, this is just a weird situation, once in a lifetime. We're going to buy this deal one way or the other. We'd like to do this to, get everybody in, and here's why. So that's one avenue we could take. The other avenue we could take is called a little bit of a hybrid. We've talked to a number of banks, and they actually will give you a line of credit against your capital, a percentage of your capital commitments. So we could go to a bank and say, okay, we've got this deal. Here's the financial summary of it. Feel free to look at it. We don't want to put our limited partners to a full-time capital call at this point. We'd like to spread it out over, the next 12 to 16, 18 months. We could set up a schedule with them where we would pull down so much every quarter from the limited partners, pay down the line of credit, and now again, that line of credit hopefully would cost less than the 8% we're having to pay out to the investors. But that'd be another avenue to go. The third avenue to go is if we pulled up a portfolio of this size that required $150 million of equity. We've also been working with a couple of capital partners that specialize in portfolios. We would probably go to them and say, guys, we're comfortable pulling 30% of our money into this deal. We need a JV partner for 70%. Are you guys interested? And there's a number of those companies out there, and they actually kind of start bidding and increasing the promote to the deal. So those are the 3 realistic ways we would handle it. Call it all, use a line of credit with a staged call, or go to a joint venture partner.
And none of them are very likely. In fact, they're highly unlikely.
But as soon as we say that, we'll get a deal tomorrow.
Well, I think if we found a deal like that, in all likelihood, we would have a joint venture partner. If we were to do a $150 million portfolio of 7 or 8 deals, I can already name 3 groups that would want to do that deal with us, and it would not require all of our money. It would just require a larger than typical percentage, because if we did it like we've done with Torchlight and some of the other groups out there that would put up, 80 or $100 million, our position on that deal would probably only be 20.
Mark, any follow-up calls on that? Does that make sense?
It makes sense.
You've done enough of these.
Yep. I think the next one is how long between capital calls and time. What is the time between the call and when you have to send in the capital?
So there are 2 dates in the document. One says that on the initial closing, we can call that money in 5 days. The reality is and then throughout the term, we have 10 business days to call the money. Here's the way it's really going to work. the people that have come into the fund, and we're going to have our initial closing on December 7th, and we're going to buy a property on the 17th, and that date may be pushed to the 19th now. So on Thursday, we're going to send out a letter to everybody who has made a capital commitment to us now and say, we're going to have the initial closing on the 7th. Money will be due by the 11th. So they're basically going to have from the 29th to the 11th to wire the money in. Now, again, this is a little bit of a difference because of the way this, everything is moving rapidly here with the fund closing and then a property closing at the, shortly thereafter. The reality is that if we're just doing a closing because of, a quarterly closing or whatever, whether we've identified a property or not, I'm going to send you as much notice as we can. We're probably going to know, 15 to 20 days ahead of time that we want to do an initial closing. So we'd be sending out a very early notice saying, prepare, and here are the days that you have to fund the money, the wiring instructions, the whole 9 yards. So you'll get plenty of notice there. The other time that we'll be doing a call throughout next year, again, there's different reasons these things can occur, is if we close on a property. Well, again, you're going to receive notice that when we put a property in a contract, as soon as we know we have it tied down and we're into that, beginning to start our, 30 and 30 due diligence process, we're going to send out a notice just like we did the summary of the property in Germantown and let everybody know, here's the property, here's our expectations, here's the equity commitment at this point, and you should be prepared to wire that money somewhere between such and such date when we send a notice. And then later we'll be sending a formal notice and announcement, here's when the money is due. But we anticipate that going out beyond the 10 days. I'll just ask the next natural question that people ask: what happens if I miss a capital call or can't make it? Well, that's two different things. Let's say you miss a capital call. There is a clause, if you read the PPM, that says it's kind of like a 30-day redemption period. If you're traveling, you're out of the country, and trust us, we have a number of investors that go to these obscure parts of the world where they're in the Himalayas and they aren't getting a cell signal and they aren't going to get the capital call notice. Well, we know they're good for it. We're going to let them catch up and come back in, within that 30-day period as soon as possible. It says that we can put a penalty on there if we want to. We don't intend to unless it's something that's habitual. So if you just happen to miss the call because of timing, you're not out of luck. You're not going to be penalized. Let's just say now, though, you start refusing to make the calls for whatever reason. You don't believe in real estate. You can't make the calls. There is a dilution clause in there. And other things occur. You will not be invited to participate in any other calls. We could if we wanted, but we probably won't let you. You will get your capital back on the schedule along with other people. I think your pref gets diluted to 50%. So instead of 8, you're making a 4 on your invested capital. So we can never just take your money, but you kind of do go to the back of the list. And I just say that because you're going to read it and it's going to be in there. But the other thing that I always tell people, if a fund is doing well, there's no shortage of people to buy your property, and if your funds are doing well, you're going to keep investing. We've had people in Fund 1 that for one reason or another, maybe it was a change in their life, a divorce, whatever, they wanted to get rid of one of their assets, and we had no trouble moving those. We just let the other investors know it's available, and we let the two of them set a price. So again, I just bring it up. It wasn't a question that was asked, but it's always one that people don't like to ask because they don't want to be the guy or woman that asked that question.
Yep.
But there's provisions to work with you, and then there's provisions that if you're not going to participate and you're going to dilute the other investors, you'll get diluted yourself.
Can you just go over how the capital calls will work with this fund versus the last fund, and what the initial capital call will be, and then how frequently you expect the calls, what percentage they may not be?
I think it's going to take us about 2 years and a quarter to spend this money. The initial capital call, we're estimating it's going to be about 20%. It may be a little bit lower. We've told people the max of 20 because we were just looking at how much we need to close the first deal, an estimate of the number of investors, and we've actually increased where Jim and I are beyond the number of investors we thought we would get from this fundraising period and the amounts. But in the max, it's going to be 20% of your capital commitment. That'll be due this year between the 7th and the 11th of December. If I had to guess, and guys, this is just a guess, I would think that next year in 2019, we're going to call between 30 and 35% of the money. I think we'll do the same amount in 2020, 30 to 35% of the money. And then I think whatever we don't call will be called within in the first 4 to 5 months of 2021. And that's my projection of how it's going to break down.
But it could go 3 years. You have 2 years.
It could go 3 years. It could go 3 years. But
and we clearly don't know the size of any particular deal that we're going to buy. It may require us drawing down $2 million, or it may require us drawing down, 10.
And the second asset you buy, say, first quarter 2019, if it's a small deal and you have new investors coming in for their first close, there's the potential for us not to have to put up any money for that close, and just the new investors would.
I think that would be my assumption. I don't think you will have to submit money in the next fund closing. In fact, you'll get a check because if you remember the way this works, the investors that come into the initial closing, when we have a second fund closing, not a property closing, so a second fund closing, those investors have to come in on a pari passu basis to the original investors in terms of the money they put into that first deal, which means that the original investors are going to get diluted in the properties they own. And so what the new investors have to do is also pay an 8% premium to come into the fund on the money that they're investing. That 8% premium or catch-up fee is paid out to the existing investors that came in, the original investors. And that's not part of your return of capital. That's not part of your pref. That is just those new investors paying you for the money you put into the first deal. And then the money that's displaced from that first deal, we hold in account, and then we roll that into the second real estate closing.
Let's say you call 20% on the first closing, and then at the second closing, you only need 15% of the total amount committed. Would you give back 5% of what we paid on the second closing, or what would happen if the total amount invested becomes 15% of committed capital instead of 20%?
We have the option of doing that, of returning that money and then pulling it back, but we want to certainly have a reserve and money to work with in terms of making earnest money deposits. But I think we'll look and see how much of that is coming in, and I don't anticipate returning that. I don't want to send money back and forth. I'd rather once we get it, we work through that and get that money spent, and then as we look and we see we're going to need another capital call, then we make the call. But I don't want to be in the business of sending money back and forth.
All right. Could you provide some details and numbers about the reserve at Southland?
We can. Did everybody get the investment sheet that we sent out on the deal?
They should have, but I can't speak for everyone. I don't know.
Okay, I'll start by pulling that document up. Just give me 1 second. Get it right here. I'll shrink this a little if I can to get it on the page. So I don't know if y'all can see it. So basically this asset is in Memphis, Tennessee. Memphis, Tennessee is in Shelby County, and they work under a county school-wide system. Germantown and Colliersville are also in Shelby County. They are the 5th and 6th wealthiest towns in the state of Tennessee. And this property uses the school systems that are located within the Germantown and Colliersville area, which are the best school systems in the area. And so that's one benefit that we like about this is around a good school system. We find that's a leading indicator for properties. It's also located within a half mile of FedEx's world headquarters, and it is pretty close to their big technical data center as well. And each of those places employ between 3,000 and 3,300 employees, and a lot of those are workforce type workers, administrative workers, et cetera. So this is a primary place for that. There's a lot of other employers. I think Nike has a big plant nearby as well. So we like the location. We like the stability of the area. Memphis has some challenges if y'all followed the city of Memphis, but just like any city that has challenges, there are areas where people want to live, and this is an area where people really want to live. I have friends that live in Germantown, so I know the area well. We're basically paying $117,000 a unit, which is on the higher end of what we've had to pay for properties. But if I had to guess with land costs in this area, I think replacement costs, you'd probably be looking in the 155 to 165 range, maybe more. Some similar properties in this market have traded in the 140s for properties similar to this one. We just think this has a good feel to it. We're buying it with two other partners, Balfour Beatty, and we actually found this deal and we didn't want to compete for it, so we were going to buy it together, and that was going to be our initial closing. We were approached by American National Insurance Company, who we've done several deals with before, and they're a large investor in real estate. They had money allocated to invest in 2018. And had some extra money. They wanted to get that out. It's like a lot of big institutions. So they don't spend it, the next year their budget gets cut by that amount. So they're looking for a place to put some money, and so they came in and offered to put in a significant amount of the equity. They're going to put in about 80%. So we've analyzed the deal. Balfour Beatty has analyzed the deal. American National Insurance has analyzed the deal, and Freddie Mac has analyzed the deal. So it's been looked at up and down. And everybody believes in our investment objectives on the property. So that's kind of a bigger overview of the property. We're on unit rehab is going to be about $4,000 a unit, which fits in line with what we're doing. The previous owner had started some renovations and had shown that those worked. They did a couple of stages of renovations, and they had proven that the more expensive renovations get a bigger bang for the buck. And so we'll actually go back to some of the units they had renovated earlier under, let's call it a plan 1 renovation, and upgrade those to a plan 2 renovation. They just, like a lot of properties, a lot of these partnerships that buy these properties, and this property came on the market, someone bought it at a good deal a couple of years ago, just like we do a lot of our properties. And that partnership reaches a timeline where to do more work, they've got to either call money or they sell the property and get a good return. And so that's why they're selling the property and why we're buying it. We think there's still a significant amount of upside in this deal.
Well, and we think we can do better work than what they were doing too, which that's not unusual. It's a great physical piece of real estate that is under rented to the market to the quality of what the units need to become.
And the cash on cash to year one, what's that projected to be?
So I'll pull it up right here. Hold on a second. Tim does a good job of hiding those numbers.
It's around 8.
That's not bad.
We run it on a 5-year model, and we run it on a 1-year model, and it's like it's just like a percentage point or two underneath 8. But it's 45% over the 5 years, which is more like 9. So
yeah, I'll tell you the numbers. It's 7.8 in year 1, 8.9 in year 2, 10.1 and 10.2 in year 3, 10.7 in year 4, and then it drops to 8 because we have an interest-only loan, and that would be when we have to start paying principal. Yep. But again, I don't think we're going to hold this past the 3 years. Our plan is a buy, fix, and sell strategy, and so we think we'll be out of that well before the principal piece kicks into this deal.
All right, can you discuss the falling yields in Fund 1, excluding asset?
Yeah, no, that's a really good question, and I would tell you that none of y'all are in Fund 1. For those of you that are in Fund 2, you know that I send out a letter every month with our distributions. We do make monthly distributions detailing what's going on in the fund and what we're selling. So remember, we're a buy, fix, and sell fund. So we know the time to sell is when we think we've, are at or near our peak in terms of returns for that property. So we unload it. What that means is the properties that are left over are probably not as performing as well. We have not gotten down to that apex, that point where we want to sell the properties. So every time we sell a property, the yield is going to drop a little. And then when we sell another property, it's because the yield overall has crept back up. And so, that's been the reason. The yields in Fund 1 have also been hurt by the property at Texas A&M University, which had some challenges. We also have a property at Arizona State University where there's overbuilding. So we have the money to maintain those properties. We have very strong joint venture partners. The Trumbull Crow family is partners in the deal at Arizona State, and a private group that we've worked with before is in Texas A&M. And so, they just have not been spending off cash, and what cash we have been collecting, we've been holding as a reserve. And so that's how we've, structured those. That's why the yields are down. We're about to sell another property, it looks like, 3-property portfolio in Fund II, which is going to, when that is done, we'll have returned, I think, all of the investor capital.
Fund One.
Fund One, in Fund One, not Fund Two. But anyways, that's the reason for the falling yields. Is we're just selling off the properties that are meeting our investment criteria, and it leaves the ones that aren't where we want them to be yet.
All right. And then how much of the $1.5 million plus of sponsor commitment is from the principals of Apexone?
All of it.
All of it.
Yeah.
All right. Well, that is the end of our questions. If anybody else has any more to type in, please do so. Don't see any more. Anything in closing you guys would like to add? Oh, I want you to go over the reduction in fees if we hit the certain milestones. Explain that.
Well, Mark, we've offered to lower the fee for your group from 1.25 to 1, and we'll do that retroactively across the board as your guys come in, and we've offered to stretch that out for a year over the 6 months, over the 6-month period. We'd like you guys to aim for a target of $6 million, and we'd be glad to offer you that, and would welcome you guys on that basis.
Very good.
It's a 50%. You get a 50% reduction of the fee for an additional 6 months. You already got a 50%, but now you're getting 50% of 1% instead of 50% of 1.25. And instead of 6 months, it's going for a year.
Yeah, and let me explain how that works. You pay the full asset management fee because, again, the fees are all part of the call, and that's what you earn your return on, your 8% and all your other returns. We then immediately turn around and rebate you that money, within a week of getting it. And so it's a return of capital to you. So that's how we keep, for the books, everybody pari passu with their commitments, and then we return, 50% of your asset management fee to you immediately upon receipt.
Gotcha. All right. Well, thank you very much for your time. It's very informative, and we'll be in touch.
Thank you, Mark, and thanks to your investor group. I know a bunch of them are folks that we've talked to in the past, and there's probably some new ones as well. So we appreciate your guys' interest in Apexone and look forward to doing some more business with you guys.
Very good. You have a nice day. Thank you. And I'll send you the recording.
All right.
Tomorrow, probably. Thank you, guys. Anybody want to discuss the fund? I think caller 1 is no longer here. I will dismiss. They are dismissed. Sounds very, very similar to Fund 2. Not much has changed, except it's callable versus paying everything up front, which will help cash drag on the fund, but it's a pain for us. Anybody have any questions, comments? If not, we'll shut her down. Take that as we'll shut it down. Talk to you guys later.